This is an ETF Masterclass designed for Europeans and Australians. The reason why it's so useful and powerful is because it teaches you a lifelong skill of how to invest profitably in a low-risk way and in a socially responsible way into thousands of companies from around the world at the same time with ETFs, allowing you to start with as little as just 50 euros or dollars. If you're a kind of person that wants to invest to build real long-term wealth and not unknowingly invest into and decisively choose to exclude, say, climate change denying fossil fuel companies or the tobacco industry or offensive weapon manufacturers or other controversial businesses as such, then this course is for you. First of all, congrats to you for joining this webinar in the first place, because as you will see in a moment, most people don't actually know how to invest and therefore are not able to capitalize on the positive potential that it has for your financial well-being. Today, we're going to cover a wide range of different topics to help you get started with understanding and putting into practice a proven strategy that will help you build wealth in the long term, that is used by the most smartest investors, that is used very widely across the world by the world's smartest investors, by massive multi-billion-dollar pension funds that literally put people's pensions into those. Because ETFs are, in essence, a financial asset that you can buy on the stock market that gives you automatically exposure to thousands of companies at the same time, rather than having to invest into a single company, and allowing you to do so with very little money and allowing you to therefore stay widely diversified in a safe way and grow your wealth passively. We're going to show you exactly how to build a risk-smart, sustainable portfolio. We'll give you the knowledge and tools to get started immediately, even with just 50 euros. This is just an example. You can start with even less than that. You can start with 5 euros or $5 or whatever currency. We're going to show you some common mistakes that you should avoid, and we're going to show you how to align your money with your moral values, making sure you don't invest your money into things that you don't morally support, like things that might increase or accelerate climate change or promote social inequality, and we're going to do this without it being at the cost of our profits in the future, because that's a common misconception, that profit and aligning your money with your moral values is not in alignment, because inherently they are, and we're going to show you exactly how to make sure that that is the case. And if you stay until the very end, we'll let you in on some additional tools that you might find valuable. Now, why am I talking to you about this? Well, a little bit about myself. I discovered ETFs 6 years ago and have since then made about 10 to 15% in profits per year since I started investing. I've looked at the historical record even before these 5 years that I started and looked at, how would it have been had I invested 10, 20, 30 years ago, whatever. And it just grows consistently because it's a very low risk strategy. And we will more clearly define this throughout the course. My father was a banker, and so I've always been very passionate about finance. And when I did my academic background in environmental management, including components of sustainable finance and sustainable business practice, leading me to start a vertical farming association that has since gained significant membership. And therefore, I really bring this passion to the sustainable investing component, which I teach in this course as well, which I hope you will find useful as well, because I remember it was a big challenge for me to align my money with my moral values, which is something that I really want to bring closer to you in this course. I have also been working across Australia and Europe in sustainable finance, sustainable business, and public affairs, really having given me a holistic overview of what's happening in global markets. Investing is something that I continuously educate myself further every single day with, learning from the world's smartest investors that I follow closely and analyze deeply. And therefore, I have created this course to give you a skill that has served me very well for these past few years and will continue to serve me pretty much until the end of my lifetime. And I want to just emphasize that if you are looking to get rich fast, this course is really not going to be for you. because this course is more about getting rich slowly in terms of building wealth over a long time and getting rich in the long term. This is going to take a lot of time. This is going to take maybe 20 or 30 years, but it's also good in the short term in terms of protecting your capital from things like inflation that devalues your money over time. But it's really not a get-rich-fast strategy, because you will not see astronomical gains from this in terms of seeing that your portfolio has doubled overnight or anything like this. This will happen maybe over 5 years or 6 years or 10 years time. This is not something that you will experience in a short period of time. So just a short disclaimer that you might not want to keep watching if that's kind of what you were out for. And, this is really a course for Australians or Europeans. If you're in another part of the world, though, it could still be useful for you. Also, we're here not making any recommendations to buy anything. Definitely do your own due diligence. Consider speaking to a financial advisor, and don't buy anything just because someone told you to. Really look at it yourself, educate yourself further, and then make an informed decision. I created this blueprint because I want to help you feel more confident and participate without feeling like you need a finance degree to do so. And therefore, I hope that you enjoy and find this useful for you. So why do we even care about this? Well, investing allows you to build significant wealth with very little effort, because in reality, inflation eats away at your savings every single day. The increasing printing of money from central banks leads to the increasing supply of it, and therefore the diminishing value of every dollar you have. Obviously, if there's a bigger supply, then the individual unit, that $1 or that €1 or whatever currency you have, is going to become worth less and less through time. And therefore, you can choose to put your money into the bank account and it will sit there and then slowly lose value over time. But when you invest it, you get a small percentage back every single month, or a large percentage depending on how you invest it. And time is your biggest advantage here, because you will earn returns on your returns. That means, wealth growth is not linear, it's exponential. Because, you would think, if I have 5% growth, you invested in the first year and then you will have 5% and then your money will grow by 5% a year. That's linear, no? No, that's wrong, actually. It's exponential. Wealth growth is exponential. And that is because you will start earning compound interest, is what it's called. So, imagine you put, 100 euros into savings and it earns 5% a year. After 1 year, you have 105 euros. But in the second year, you earn interest not just on your 100 euros, but also on the extra 5 euros from the first year. So now you earn 5% on 105 euros, giving you 110.25 euros. So this keeps happening every year, with your money growing faster and faster over time. And it really starts to snowball. And so the longer you leave it, the more the snowball will grow in size. And so, you can see in this graph that, in the first year, it'll be 5%, so 1,233. And so, at some point, you will get like 60,000 euros in 5 years by doing nothing, by just investing 100 euros every month, you see? And so, many of the funds typically will grow 8 to 10%. There's some funds that we will also show you later that actually grow by between 10 to 15%. And you really see that if you just do this little habit, and at some point you will probably earn more to be able to invest more as well, allowing you to grow it even faster. But just if you, for consistency's sake, put a small amount of 100 euros every month, which is really not a lot, into an ETF, it will grow significantly once you hit several years of doing that in a consistent way. So just wanted to show you this to kind of show why it's so important to start as early as you can. So yeah, check this out. If you invested 10,000 euros 5 years ago, for example, you would have had an average of 12.75% per annum growth. These are three common ETFs that you would have in euros, so in Europe, that you could invest. And, after 5 years already, like you've got a total gain of 4,000 euro for the world ETF. Then there is one on emerging markets, having, for example, India, China, and so on in there with 3,900 euros growth. And then you have one on 600 largest companies. I think it's even a lot more than that in Europe with about 3,300 euros growth, And so you would have already made like 6,800 in total. So you would have 16,800 starting with 10,000. So, that's just 5 years. And, so just letting you know, and then there's the same also for the Australian one. So if you look in here, you will see there is the emerging markets, world and Europe ETFs, which also have, thousands of companies from there. And the value will have grown significantly, 12.5% per annum. And all that for just a small order and then just waiting for 5 years, doing nothing, basically. You don't have to do anything. You can enjoy your life, do whatever, and take advantage of these gains. Let's be real. Most people don't start because they're overwhelmed or afraid. Some people think you need thousands to start, or are paralyzed by the jargon or worried about losing all their savings in a crash. And for those of us that care about the planet, there's the added worry of, what am I actually funding with my investments? If any of that resonates with you, you are exactly who this class was made for. And trust me, you're not alone. In fact, the majority of people, especially in Europe, are not investing at all. And the good news is you're here. So that already puts you ahead of the curve. Saving alone is not enough. Inflation reduces your money's value over time, about 2% per year. So, imagine, super random example, but let's imagine your grandma has 300 euros or dollars under her mattress to buy a TV in the future. Today, the TV costs 300 euros, but next year, because of inflation, that TV is going to cost 315 euros. The prices go up all the time. So she has still got 300 euros under her TV, under her mattress. But because inflation eats away at your savings, the 300 euros is no longer enough to buy the TV. And so you see, as you have your money in your bank account, it actually loses value over time. And the interest rates are quite low. So if you put it into a bank that might give you some money back, it's not enough. Like it's about 1 to 2%. It's about the same amount as inflation. So worst best case, your money, maybe slightly grows or stays the same. Or even decreases in value. And so investing lets your money grow faster than that. So in this course, we're going to show you the passive investing strategy. It's letting the market work for you, letting your money work for you. That's what we will show you. You don't have to pick individual stocks. You buy the whole market. You don't need trillions of euros or dollars for that. You can start with maybe just 5 or 10 or whatever. And ETFs are exchange-traded funds. We'll explain that in a moment. They track major indexes. For example, an index is a set of stocks or companies, like the S&P 500 is the 500 largest companies traded in the United States. And so they're the biggest companies. Some of them are the biggest companies in the world. And so there's no need to follow the market, follow the news, and listen to your friends and think about, what next big stock am I going to invest into because it's totally going to explode in value. How many times have we heard this of, wow, there's this new stock that's going to explode in value and we will become rich overnight or whatever, and then you buy it and then whatever, like the thing goes into the toilet. Like it happens all the time. There are people saying that things will go through the roof and then nothing happens, or it just goes into the toilet, whatever. It's just not worth it to try to do these things unless you're like an insider, because most often it will go wrong, or like you just won't have the gains, and it's very hard to actually outperform the market. The biggest hedge funds in the world, actively managed, there's very few of them that can actually beat the markets, the smartest investors in the whole world. So if they can't outperform the market portfolio, then how could you, as someone that doesn't know and that might listen to their cousin in terms of investment advice that, just reads Reddit all day, how is that going to perform better than that? And so ETFs are a very easy way to just follow the market and see what the companies do, get an average return of the performance, maybe 5, 10, 15% per year. And that's it. And then you don't have to worry about, am I going to become a millionaire overnight, or am I going to lose all my life savings? That is not even investing in a way. It's more like going to the casino and hoping that whatever you buy will, land on the color that you chose. It's like going to the roulette table. It's not investing. You're not investing, you're gambling. And so what we're going to go through here is passive investing, allowing you to make slow, consistent, low risk gains through time, throughout, a very, very long time. So let's go through some of the risks to move from uninformed optimism to more of an informed optimism in terms of, how can we actually manage our risks here? There's market fluctuations. There's big crises going on. In 2008, there was the financial crisis. There was the large-scale fraudulent lending of mortgages. And these have been packaged up and resold so many times that it was super untransparent. And it was basically a whole big banking fraud that was happening. And as a result, the stock market crashed by over 50%. And now it's higher than it has ever been. So in 2020, there was the COVID-19 pandemic. The market crashed, but it recovered quickly. Some actually types of stocks have actually done very well. Often these crashes are seen as opportunities because suddenly everything is low. That's when most, retail investors might think, terrible, stocks going to zero. But the rich will really think and see this is an opportunity. This is a lifetime opportunity to pick up real low price stocks. And so, these things just happen. But in the long time, the market always recovers. In this passive course, we're more looking at, actually not being an emotional investor. We want to be consistent and have a strategy that's not based on emotions, but it's based on a proven system. Avoid panic selling when the market drops. As you see the cliff, you don't want to jump. When you keep it, in the long term, the stock market just will recover because these are the biggest companies in the whole world. They make up the world as we know it today. And so if you give them a few months or years, or, maybe sometimes even, 5 years or so, or 3 years, then these will have recovered normally. In the long term, these companies just will recover. And so there's also the sector or theme risk. As we go into sustainable investing, for example, we'll show you some funds, some exchange traded funds, a group of companies that you can buy. And they might be of a certain theme. So there's different types of ETFs. We'll go through them. And there's some, for example, if you buy a fund that contains a lot of renewable energy companies, because you think that's going to be the next thing, there could be a risk that through changing political environments, those sectors might be impacted. And so, there's that risk. So therefore, we want to pick broad market ones because they are more diversified across different sectors. And then there's extreme scenarios. So as we explained, if there's a global apocalyptic catastrophe happening, that could lead to your portfolios going very low or even to zero, hypothetically. But, when you spread your investments widely across global markets and sectors, it's extremely unlikely you'd lose everything, as we say here. For your entire investment to go to zero, virtually all world's major companies would have to collapse. And if that ever happens, we'd all have far bigger problems than our portfolios. So, keep that in mind as you go forward. So there is risk. There's always risk with investing. There's risk with saving. There's even risk with having your money in the bank account. There's risks with cash. There's always risks. But, see for yourself, do your own due diligence. And we've mentioned a lot of this already, but let's just go through it one more time. Like, passive investing tracks the market. You buy and hold, you wait. They're low cost because these funds have a fee associated with them. The company that manages that fund will charge that. It's very, very low. The risk is very low. The time commitment is minimal. Once you set it up, it requires no effort. And the performance is consistent over time. Active investing, you want to look to outperform the market, not track it. It's hands-on, so you need to research, you need to buy, you need to sell. You have higher costs because, you take a lot of time. Time is money. You pay fees every time you buy and sell a stock. That's another thing to consider, to the broker platform that you use to do that. And, that takes, it's a small chip fee every single time, maybe 1 or 2 euros or dollars. But, those add up over time. If you do a lot of these trades, the risk is higher because you have to do a lot of research. You rely on your sources. And, the payoff is statistically minimal. And the time commitment is large. And unless you're Warren Buffett that's watching this, it's very unlikely you will actually outperform the market. Very unlikely. The world's greatest hedge funds, a lot of them that are actively managed, don't manage to do this. So let's actually get to it. Now, what is even an ETF? An ETF stands for Exchange Traded Fund. Exchange means it's traded like stocks on the stock market. And just to let you know, we'll define that more clearly in just a sec. Traded is you can buy or sell at any time. And fund is that it is a basket of stocks, bonds, or other assets. A stock is a single piece of ownership in one company. So when you own a stock, you own a percentage of a certain company. So if you own an Apple stock, you own a small percentage of the company Apple. And its value changes based on investor confidence and the company performance. Often it's this term called mass psychology. The term mass psychology is used to say that, when we're confident the market is doing well, the stock prices will rise. And it's not necessarily based on company performance, but obviously company performance, like when they show their balance sheets and whatever, it does impact the stock market. So if they are producing a lot, or they got a really cool, innovative, cutting-edge new product that's, blows the market out of the water, then that will often lead to higher investor confidence and therefore the stock market to grow. But it's very difficult to predict. And owning a stock means you may get a share of the company's profits as well. Often companies pay out some profits to their shareholders that they make. Typically, large oil and gas companies like to do that as well. They pay out a small proportion called a dividend to their shareholder, which you can then get some extra cash flow. Often this is about 5%, 4%, 2%, 3%, something like that. An ETF, on the other hand, is a basket of many stocks or other investments in one single fund. So you're buying like a stock. So you go into your app and whatever you buy a ETF, it's like buying a stock, but now you're just not buying one company ownership percentage, but you're actually buying ownership of hundreds or even thousands of companies at the same time. So it's like going and when you're cooking, instead of just eating raw pasta or just eating cooked pasta, it's like you have a mix of different ingredients in a single meal instead of just one of them. And you might have a fruit salad with like an apple, banana, kiwi, yogurt, and you mix it all up, that's what you get. Whereas the share would be just the apple, And so therefore you get more exposure, more diversity, not just buying into one company that has a headquarter in one country, but you're buying thousands of companies that have their headquarters in various different countries, do business in various different countries, and are therefore impacted by the global changes occurring in the world, which means that you're less prone to a risky decision if you buy like a share in one country, because you are now no longer just exposed to the risks of that one country or that one area where your stock is located and the operations that happen within the company, but you are more internationally diversified, because let's say if there's a crisis in one country, you still have thousands of stocks in other countries. So, you have a very low risk profile. So if you have an ETF that say tracks the S&P 500, you own 500 companies. Or you own shares of 500 companies. You don't own the companies, but you own a percentage of these 500 companies, depending on what type of ETF you choose. And so you basically follow the market's performance. And you see Now, if one of these companies goes bankrupt in your ETF, that means your ETF value will go down a little bit because, one of the companies just went bankrupt, but you still have 499 other companies in there. And that one that goes bankrupt will just be replaced by another one. And then in the long term, the thing will just go up again. So, and you see, if you buy one stock, the stock goes bankrupt, well, too bad. Your money's out the window, it's gone. So ETFs will help you mitigate that type of risk. So it's low risk, it's diversified across countries, across sectors, across companies, and it's hands-off. You don't pick a single stock, you don't have to do too much research, and you easily trade it. So let's dive into the meat. The 3-step framework, ETF investing blueprint that we prepared for you. 3 steps. Step 1, set your goal. Step 2, choose your ETFs. Step 3, automate and optimize. And we'll go through each and every single one of these steps, showing you exactly what to do. Step 1 is really about setting a very clear goal, because without a vision, there's not a clear path towards achieving it. So that's very key. You need to make a financial plan to inform why are you even investing. Are you focused on growth? You're probably looking for long-term wealth or higher returns, even if it comes with up and downs. If you're looking for income, you want ETFs or exchange-traded funds that pay you dividends to help you cover bills or supplement your income. Or if your top priority is safety, then your exchange-traded funds should aim to preserve capital, even if the returns might be lower. And then there's also this extra crucial layer of aligning your investments with your values. For example, if sustainability matters to you and you want to choose something that invests into companies that align with your values, that, for example, invest into green energy, exclude companies that you disagree with. These are all important things to consider. Now, back to the financial plan. You need a plan. You want to have a vision of where are you going to be at a certain time, and then you want to make a plan, of how to achieve that. You want to have clearly defined your expenses, clearly defined your income, clearly defined your assets, and clearly define your liabilities. Now, assets are things that put money into your pocket, and liabilities are things that take money out of your pocket. And so, for example, an asset would be a ETF that grows in wealth over time, or a real estate investment property that gives you monthly revenue from rental income that your tenants are paying you. Or another asset would be gold, and a liability is something like student loans. They're costing you monthly, and actually having this debt is actually very negative, because it can actually compound as well, this compound interest of investments. It can also go in the complete wrong way when you have a lot of debt and you have interest on that can stack up. So, therefore it's always important to pay off your short-term high interest debt off first, if you have it. And so you want to align your investment with moral values, and then you want to make a clear plan of, what is the vision? 500,000, say, by the 2030, end of the year. And then you want to have a clear plan of how you get there. And you want to then say, okay, so I probably need to start saving this amount of money to achieve this amount of money by this amount of time. And so I would have probably a 1-year interim goal, and then you can start saving up to that, and then start forming a clearer picture of where you want to be by a certain time. In this case, we're giving you an example here of wanting to save 10,000 euros, or you could make it 10 or 15,000 Australian dollars in 12 months, which may be more of a reasonable consideration for you depending on your current financial situation. But you can aim for this or adjust it if you're also a student, and basically have this 1-year interim target, and then basically making you think about how much you actually need to save. What is the actual number that you need to save each and every month? And then you can also try to add additional monthly income. What are some ways that you can add to your monthly revenue? For example, you can invest into dividend stocks that pay you a monthly revenue. You can try to find an additional side hustle to do. like work some additional hours or save also some money, because saving is also a very key way to reduce your costs and then therefore improve your monthly income. And therefore, then you can basically put that into practice by putting percentages or numbers, specific numbers, to the amount that you want to each and every month save/invest or spend on pleasure activities or spend to donate or spend to pay your expenses that you have. And we've given you here also a little bit of an example of how you can model your account. This is a way that basically I kind of model my account in a way, the numbers are different, but you get my point, like the percentage points that you can put into practice to start saving each and every single month and get into a healthy financial habit that way. Step 2 is choose your exchange traded funds. They should be low cost, they should be diversified, they should have a historical growth record that is strong. They should align with your moral values, You should look at the holdings. What are the top companies in there? What are the companies? Are there any companies that I don't want in there? This is something we'll dive into later on as well. But this is the broad overview. And so if we look at this next slide, we see that there's a portfolio that we've created here for Europeans, which is a common one, which has 3 key components. The first one is a world component. So it's a global ETF that invests in world companies. Then we have a more specific one on European companies. So the Money Stocks Europe 600 and the iShares Core MSCI Emerging Markets, which is India, China, Taiwan. In a way, some of these countries maybe are not really emerging markets anymore. So in any case, these are the 3 core areas of the portfolio that we've listed here, which gives you a very broad, diversified portfolio of thousands of different companies that are included within these 3 ETFs across the whole world, meaning that if one part of the world is impacted by something, you will not completely lose out on your portfolio growth because it is likely that other parts of the world are doing very well in the meantime. And so if you look at this next slide, we see a bit of snapshot. So this is from this website called Just ETF. This is a European portfolio. We'll go into the Australian one in just a second as well. And this shows the iShares Core MSCI World ETF. And basically, it is a globally diversified ETF. But if you look actually at the holdings, you will notice that, yes, it is a world ETF. It has world companies from around the world. But it does have a lot of US bias. You see, there's 67% US companies in there. And so you just want to mention that because that's not necessarily the definition of a diversified portfolio. But in any case, that's why we included these other ETFs in there as well. And so we've got 1,350 holdings. The thing has been in existence since 2009. There's a lot of people that have invested into this with a lot of money. The fund size is very large. A lot of people have paid into this. And so the largest holdings are Nvidia, Microsoft, Apple, Amazon, a lot of tech companies that we see here. And so, yeah, this is a very large ETF. Another interesting thing to look out for is the distribution policy. You see here it mentions accumulating. And then there's another distribution policy that it could say, which would be distributing. Now, there's no right or wrong answer here. It really depends on your preference. But what it basically means is that broadly, just to let you know, firms like Microsoft, like Apple, at some point, they decide to, several times throughout the year, potentially pay out profits that they make to their shareholders in form of something called a dividend. This is basically a payment that they make to make their shareholders happy. Everyone that owns a percentage of the company kind of gets rewarded. Some companies do this more than others, like oil and gas companies, often supermarket chains and other energy companies often pay out dividends to their shareholders to make them happy, to make everyone happy, because, it's a little bit of profit, typically around 5%. And now this ETF, basically, because it has these thousands of holdings, right? Then if there's a distribution policy, it basically means how do they deal with these dividends that these companies pay out? And there's two forms or two ways that they do this. The accumulating version means that basically they have the dividends, they take them, and they automatically, without you having to do anything about it, reinvest it into that ETF. So that means accumulating. You are accumulating the gains of this ETF, and it's automatically reinvesting into itself with these profits that are being paid out to you. There's another one called distributing for those people that prefer to have a little bit of side income from these ETFs. Some of them, they pay about 5% per year, because there is some ETFs that focus on dividend companies. So they will have a lot of these companies that pay dividends. And so let's assume, for example, a common one that you would then tend to get is 3 to 5% or something like that is what they pay out. And then you will basically receive this money if the distribution policy is distributing into your brokerage account. And so in this case, if you're just starting out, just learning how it goes, I think, also if you don't have a lot of money yet in them invested, it makes sense to choose accumulating, because that way you make use of the compound interest that we explained later, which really snowballs in the long term, where you will reinvest, and make interest upon the interest payment you've already received. And that's, how you really snowball your wealth into the long run. If we look at the next slide, we see that over 5 years, this thing has grown by 87.66%. So in 5 years, this thing has grown by 87%. Had you invested 5 years ago, $100, you would now have $187. Same with if you had 1,000, it would have been $1,800, and so on. And so that just gives you to show how strong this growth has been, even if it is the 500 or so, 1,350 companies from the US from this index, which means it's a super strong growth record that we see here. And so now we have an Australian portfolio here for people that are investing through the Australian Stock Exchange. And we'll show you just, which platforms are good to actually do the investing through in a moment, a very key part. And so in the world segment, we've got the VGS ETF. For Europe, we have an ETF called IEU. And then for emerging markets, we've got IEM, pretty much the exact same principle here. So if we look at the next slide, we see, 72% US basis, 5.7% Japan, and so on. So, it's kind of a similar situation like in Europe, where you have a large portion of US holdings of this one. And then, it's the largest holdings, also similar: Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, and so on. So it's a very similar picture. And if we look at the gain over the last 5 years, we've also got a pretty similar picture. I think the other one was 87 or 86%. This one is 83 to 84%. So, not really a big difference here. And just consistent growth that has really delivered into the long term. And so, had you invested 5 years ago, you would have made significant growth. And that really shows that this is a consistent strategy. And so, have a Google of the other ones, just to familiarize yourself with them as well, like the holdings and so on, what we just went through. For Europeans, the Just ETF website is great. For Australians, you can look at the ASX website, which is really good for providing all these details. Then step 3 is a really key one. You want to invest, automate, and optimize. It's very key to do something called dollar cost averaging, which reduces your risk from timing the market, which means basically you're just investing at a set time every single month or every single week, whatever you prefer. Probably every single month is good enough. You take a long-term approach, you maintain emotional discipline, and you just start. Because, all this is great. Talking about all of this, it's super interesting. There's a lot to learn here. But, if you don't take action, nothing will change in your life. And so it's really about taking that first step, even if it's just a small amount, just do it, just get started. Because You can learn about as many things as you want, but it's not until you actually do them and implement them and put them into practice that things will actually change for the better. And so that's why I can really just say, just get started. The first one in the next the next slide is practice long-term investing. So, it's not likely that you are Warren Buffett or a C-suite executive of a large company and you are able to perfectly time the market, because there's people that think they want to time the market. I'm not going to buy right now because the stock price is too low and I think it's going to drop, and then I'm going to buy all of it and then it's going to shoot up. It's stressful, it's a waste of time, and it might end up making you lose a lot of money. Investing a set amount every single month into a fund helps you mitigate this risk. These funds, like the volatility of them or like the way that the price goes up and down is quite low. Like it doesn't like move extreme amounts every day. Not like the crypto market, for example, because there's so many companies in it. But if you just invest every single month over a 5 or 10 year time horizon, you will always make money. In most circumstances, you will make money, unless you buy a very shitty fund that is super random. It's a very consistent strategy. You want to do this, and ideally you can automate this so that you can set and forget and not have to worry about it. You can take a long-term approach. You want to buy and hold. You don't want to sell this thing in a week or 2 or even 3 or even a month or even a year maybe. You want to invest with a long-term mindset. Buy and hold. The more time you take, the more you're going to gain. And you have more time to pursue hobbies and other career goals rather than looking at your portfolio every single second. Or looking after family, hanging out with friends, do whatever, makes you happy. Because it's passively generating you income. And it doesn't require you a lot of time to do that. And so there's many tax advantages of doing this. Many countries, including Australia, for example, and Belgium, they will tax you for speculating in the market. And what I mean with speculating is if you buy and sell in quick succession shares in the share market, because you buy low, you sell high within a day, an hour, whatever, short times. And they will tax you on this. So you have to pay more taxes to the government. Whereas if you just bought and hold for a long time, they will often, after holding it for more than a year, enable you to pay less taxes because they actually want you to invest. The government wants you to invest because it's good for business. It's good for growing wealth for the country. It's good for growing business opportunities, for creating a more healthy, prosperous society, and therefore the government supports you for investing your money. So therefore, taking a long-term approach is effective in many ways. And then the next slide, you want to maintain your emotional discipline. You don't want to sell when the market crashes. As we said before, when you see the cliff, don't jump, because these things will grow again in the long term. And the risk is that if a crisis happens, like, a COVID pandemic, and suddenly everything drops and you think, oh no, it's the end of the world. You want to invest, get rid of all your money. First of all, you want to have a savings cushion. You want to have at least 3 to 6 months of savings saved up so that you can live off money in an extreme event case. Like, for example, you lose your job. You want to have 3 months of savings so that you can keep living off that while you search for something else or something like that. So you don't want to be in a state where you have to sell your investments. And because the risk is if the market does drop and you sell, that you sold at the worst possible time, and then shortly after it will recover again, like it did with COVID. 2 years later, market was back to normal. And, it's just too risky to actually, sell it. So if it really goes down, you can perhaps send a stop loss. But in the long term, these things will just end up going up. And then, as we said before in this slide, is just start. Analysis paralysis is common when you start. The sooner you start investing, the earlier you get to reap the rewards. And the more your investment will compound over time. In the long run, you will make so much from these early investments. And so when choosing your global ETFs, there's little that can go wrong in the long term. And continuous learning is key. Always educate yourself further. Don't just trust me. Look broadly, look in the internet. I'm not a one-stop shop, person that you should consider. You should always diversify and look at all the information that's out there and make up your own mind, because at the end of the day, we're not giving any recommendations. There's just information for you. And now this slide is very important. You want to create a brokerage account. Now, many big banks offer these typically as well. Some of them charge quite high fees. And so we provided here a list. You can also check out some links below the video description that allow you to sign up because they have low fees. I've tested them myself. I like these brokerage platforms, but these are platforms that essentially link your money with the share market. And depending on where you live and where you trade, you want to choose a certain broker. And so, for example, for Australians, we have here Interactive Brokers or Stake that are quite good to get started. And we have some links below. If you get started with them, you get a little reward as well. And I do too, but I've tried these myself and I think they're pretty good, but you can obviously use any other platform as well. For Europeans here, we've got listed Trade Republic, which is quite user-friendly, and Interactive Brokers, where you can buy international shares. So you can even, through Interactive Brokers, as a European, buy Australian shares, or as an Australian, buy European shares. And with Stake, as an Australian, you can also buy US stocks. So that could be interesting if you want to buy some Amazon, Apple, and so on. So these opportunities exist out there. And if you look at the links below the video, you can sign up, get a little reward, and get started today. And you're already ahead of the curve. You're already here. You're already taking action. You're already watching this video, trying to learn more, trying to get behind this idea of investing and put it into practice. So, you're already ahead of the curve. But, if you learn and you don't take action, nothing will change. And so, take action today or don't. Make up your mind and get started. They have different fees. So I would familiarize myself with how much they cost. These are all free platforms. So you can all create an account for free, but you have to pay I think a €1 transaction fee in order to make a investment. So these are things to consider. Also, these are brokerages that are available, that have a great ETF availability. There's also brokerages that exist and they don't have a great ETF availability. They have many shares, but you can't actually buy ETFs. And so I chose these ones because they do have a good ETF availability and therefore allow you to choose exactly the ones that you want to invest into. And do your due diligence and get started. All right, now let's talk about sustainable investing, because for many people, investing is not just about numbers anymore, but it's about what your money truly supports. And this is certainly also true for some of the world's most successful investors. Whether this is private individuals or institutional investors, we can take one example of Bill Gates. He founded Breakthrough Energy Ventures, which is a $2 billion fund focused on investing in cutting-edge clean technologies that can drastically reduce greenhouse gas emissions. Because Bill Gates believes that divestment doesn't necessarily reduce greenhouse gas emissions by, say, taking your investments out of companies that you might think unsustainable. But he's obviously a tech guy. He founded the big company Microsoft that many of you might know. And therefore, he's very much into technology solutions to solve modern problems. So him and his team are working on sustainable solutions in areas like clean energy, agriculture, and sustainable manufacturing, showing that big innovation can go hand in hand with strong financial potential. Another example is of the Norwegian Sovereign Wealth Fund, which is the world's largest, which actively excludes companies involved in severe environmental damage, coal production, and unethical practices like human rights violations. And so they apply strict criteria to exclude companies that are not considered sustainable, and therefore they have a powerful demonstration of how institutional investors see environmental social governance not as a sacrifice, but as smart risk management and long-term value creation strategy. The good news is that for you that is watching this video, we're going to go through some strategies today that you can implement to make your portfolio more sustainable. And we're going to provide you with some funds that you can potentially include in your portfolio as well. Some key reasons why we should care as investors, even if we don't care about the planet and social well-being, is because it is increasingly threatening business continuity in the long run. Companies are responsible both for and impacted by environmental and social problems. And these actually are a threat to business continuity going forward, because climate change is a threat to us. We're facing fires, floods, extreme heat, lethal humidity, various things that are affecting people and businesses right now, and therefore tanking stock prices. And while some countries around the world have not woken up to this fact, it is actually happening, and the risks of not considering sustainability within your business operations is a critical issue that will impact financial returns in the long run. So sustainable investment not only aligns your money with your values, but also helps you mitigate risks of long-term business continuity being reduced because of extreme environmental conditions with climate change. A very common term that's used when we talk about sustainable investing is so-called ESG, which stands for environmental, social, and governance. Environment means how companies treat the planet in terms of their emissions, their pollution, their energy use, and their waste management strategies, and so on. Social is how they treat people, employees, communities. Looking at the broader value chain in terms of, are we actually improving social conditions in the surrounding of our business operations? Like, are we encouraging, for example, like workshops and these kind of things for capacity building in the local region? And are we treating our employees well? Then there is governance, like how business is run. By, for example, encouraging transparency, whether there's ethical management, whether we have, board diversity, for example, and whether we have fair pay, or whether we are encouraging key KPIs for senior management to promote social, environmental objectives, and these kind of considerations. A huge myth floating around is that sustainable investing automatically means sacrificing profits, but the evidence simply doesn't back that up. In fact, around 90% of academic studies have found that ESG investing either has no negative financial impact or actually improves returns, as cited by the studies down below. And then sustainable investing isn't some tiny niche either. By early 2020, global sustainable investments have reached $35.3 trillion, representing over a third of all professionally managed assets worldwide. Now, the reason why sustainability often leads to strong financial performance is because companies with solid environmental, social, and governance practices tend to be better managed, more innovative, and less exposed to costly risks like lawsuits, scandals, or even regulatory crackdowns, which makes investors more confident in an organization and therefore increases its share price, which the studies that I've linked here show as well. So then in crises like the COVID-19 pandemic, sustainability-focused companies hold up better than their peers, according to research from MSCI, because they're generally more resilient and adaptable under pressure. And beyond just returns, ESG leaders often enjoy lower borrowing costs in financial markets. This is because they have access to lower interest loans because of their sustainable activities, for example, among other reasons, allowing them to save money that will flow back to the shareholders in a way. Broadly speaking, investing sustainably is more than just a financial choice, but a way to align your money with your moral values and advance progress in whatever way you think is suitable for this world. Whether it's to be more clean in terms of the energy that we use, or whether it's fairer social conditions that you're looking for, or if you're looking for both, or if you want to divest your money from things like defense, or whether you actually think it's a good thing and you want to put your money into that, you can align your investments with those choices and do so in a very profitable way. And just to elaborate on some of these points a little bit more, we have a lot of benefits coming out from being sustainable, like these organizations that are sustainable, that have, for example, a plan to reach net zero emissions, as well as a waste strategy. And, these things are just very key going forward, because we have different pieces of legislation that require organizations to be sustainable. In the EU, for example, there is the climate target of net zero by 2050, and the emissions trading system makes it increasingly expensive for organizations to not reduce their emissions and keep polluting, for example. Australia aims to achieve net zero by 2050, and there's the safeguard mechanism, which tries to do a very similar thing, making it increasingly expensive for organizations to not meet their climate obligations. And of course, these things change, but if you want to be safe, you want to ideally have sustainable practices in place. So in case these legislations do come into effect, your organization is well positioned to deal with them. There might be labor standards coming in as well, requiring certain pay classifications for people that work in certain jobs, that therefore makes companies more risk tolerant when they actually have these measures already implemented, in contrast to organizations that underpay their workers and then are suddenly impacted by a regulation that they did not see coming. So therefore, if we look in sum with all these things, companies that are just sustainable are more well positioned to continue to exist with changing socio-environmental regulatory conditions. Now let's get practical. In this masterclass, we're going to walk through two types of sustainable ETFs that you can get. We're looking at exclusionary ETFs or thematic ETFs. So first one is exclusionary, because many people want to avoid industries, so-called sin stokes, things like fossil fuels, weapon manufacturers, tobacco or gambling companies exploiting workers, etc., etc. So when it comes to sustainable investing, one of the most powerful steps you can take is deciding what you don't want to support with your money. Think again of the Norwegian Sovereign Wealth Fund, how they do it, and how they have done it successfully for many, many years. Investors can choose to filter out these so-called sin stocks, companies that are tied to various organizational elements that you might not like. For example, not paying your workers, or, being involved in oil and gas, weapons, defense, tobacco, alcohol, gambling, all of those things, and those responsible for high carbon emissions and major ESG scandals like human rights violations or environmental disasters. So you can aim to replace these exposures with greener, more responsible alternatives, businesses that are carbon efficient, embrace board diversity, innovate in clean technology, and operate with greater transparency and ethics. So we have, for example, an ETF listed here for both Australia and Europe that you can check out. These are broad world ETFs, although, once again, a strong US component as well. But the world ETF, for example, here has this ESG screened criteria included, which means that it screens out so-called sin stocks. And, there's obviously different definitions of that depending on what your moral values are. So you can compare this one to other ones that are available and see what you morally support, because I believe this one does include conventional weapons, while other ESG ETFs might exclude conventional weapons. But this one excludes a lot of different sectors like oil and gas, coal. It excludes gambling and tobacco and alcohol and various other industries. And then in Australia, there's a similar situation with the VESG ETF that also excludes various different industries, but it excludes, it might not exclude certain industries that you might consider unsustainable. And so what I really want to stress here in the slide, it's very important to do a little bit of digging yourself. Look at the actual holdings. They have these pretty names. Oh, we exclude oil and gas. We exclude tobacco and alcohol. We exclude gambling. But it is really up to you to check the actual holdings in there, because you can be very surprised. Like, I have looked at an ESG ETF before where I thought, wow, it's amazing, it excludes all these things. But then when I look under the hood, you might be surprised at the holdings of this ETF. So really look at the holdings and then make up your mind if that's what you want to go with. Obviously, in context of all the other things like past performance, the number of holdings, the fund volume, and all these other metrics. Then in the next slide, I just want to emphasize here that we are still tracking the market. This is an ETF. These are ETFs that I've mentioned here that are still tracking these broad market indexes like world largest companies. And we're excluding, though, for these organizations that are involved in business activities that we consider as unsustainable in this case. The fact that this is tracking the market, though, is great because it allows us to passively invest broadly into the market and not go to the casino and think about what's going to be the next runner that will go to the moon but will likely not do it. You still invested very broadly if you pay attention to the ETF that you buy in terms of how well diversified it is, allowing you to benefit from the broad market growth. Then the second type of ETF that exists is a thematic ETF. Stocks involved in a certain theme that is considered sustainable, like renewable energy, battery technology, sustainable transport, and so on. And so they are more kind of targeted towards a certain theme that we choose, and therefore it is less of a passive investing approach. We have two examples here being like the LNG battery value chain ETF for Europeans. And then in Australia, we have the CLNE VANEC Global Clean Energy ETF. These, track different themes and rely on us making a choice of what we consider as, the next runner. And it's always a bit of a risk because it's very hard to predict what will happen. If we take, for example, the renewable energy ETF, maybe at some point we'll have a political party in power in a certain place that has a lot of renewable energy projects going and therefore driving up share prices. But then, there might be a big push for nuclear energy. And then suddenly nuclear becomes the next big runner. Nuclear, because you are burning uranium or you are consuming uranium, it is not technically a renewable energy source. So maybe that won't be included in the ETF, and then the share price goes into the toilet, and that's because you weren't properly diversified. So it's kind of like a risk to pick an active industry that you think will be popping off. And while these that we listed here are probably going to be very relevant going forward, it's always better to be broadly diversified in the market to avoid being caught up in something where you might be picking a loser and you just don't know, but it sounds very good and it sounds super relevant, but then it won't be. So it's a risk that might not be worth taking, and perhaps it's worth to instead, allocate a small amount every time here and there if you want into these types of ETFs, but it's very hard to predict what will happen in the future. So this is maybe a bit of a revisit, but let's go through it again. 3 big myths and how we're going to bust each and every single one of them, or partially bust. So first one, sustainable ETFs always underperform. Well, we have seen that they actually don't always underperform, as you can see here. This parent index being the iShares Core MSCI World UCITS ETF has 112% over the last 5 years. And then this is also taken since the inception of the Sustainable Fund. So the Sustainable Fund, being iShares MSCI World ESG Screened, has grown by 122%. So there's faster growth, 10% more over this time since the fund inception. Then we have ESG ETFs are not as diversified because they exclude certain industries. Well, we can see here that Vanguard International Shares has roughly 1,250 holdings, while the sustainable version, being VESG, has 1,450 holdings, being more than the parent index. So that is also incorrect. The third myth is ESG investing is just marketing. Now, this is definitely a key critique point of sustainable investing that I want to discuss here. The way companies run is very complicated, and therefore it's often very difficult to actually see how sustainable a company really is. because there's the obvious weapon manufacturing companies like the company Rheinmetall that, do that, and they're, very upfront and honest about it. But then there's a lot of hidden supply chains that are going on. There's a lot of car companies, for example, that might be producing tank part components for a weapon like manufacturer. And so it's not always very easy to decide, is that considered a sustainable organization that might be building EVs, but also tank components? Or are fossil fuel companies that invest significantly into renewable energies also considered sustainable? Should they be excluded from a sustainable fund that says it excludes fossil fuels, although they are part of the solution in terms of progressing a renewable energy future? So this is a very important thing to just be aware of or be mindful of, that it's not very clear here that even though it's a sustainable ETF, that it doesn't actually mean that it is sustainable. So you need to look behind the hood. What is the fund actually holding? Does it say they exclude fossil fuel companies, but they might still have it in them? Because as I said before, there is sustainable ETFs that have fossil fuel companies in them as well. And you would be sometimes very surprised what you can find in them. So definitely, to avoid this, there is a little checklist that I prepared here, which is basically you want to check the sustainability criteria. Does it even make sense? And is it transparent? If it doesn't make sense and if it's not transparent, then, that's a red flag. Usually you have to find some kind of fact sheet and some kind of methodology that clearly explains what is excluded in this ETF. If the fund doesn't provide this information, then that's a bit of a red flag in terms of, these sustainable funds try to promote sustainable or ethical governance, which includes transparency, but the fund itself is not transparent. That's a bit ironic, don't you think? And then when you look at the holdings, you want to have a look at those. Are there any surprises in there? Are there organizations that you did not expect, that you do not morally support, although the label is pretty and it says ESG conscious, Paris aligned, ESG fund, whatever? It might not be including the companies that you would normally expect. Then there's also the option to compare third-party ESG ratings. There's, for example, S&P Global ESG scores. You can type organizations in there and then find more information out about their sustainability practices there. And then you can read a company's ESG report. This is a bit of an advanced tip because it requires you to do some reading on the organizations that are in the ETF. So probably for the largest holdings, that would make sense. You could look at things like, are they even committed to becoming net zero? Do they have a zero waste target? Do they progress board diversity? Do they care about adequate support for disabled employees and these kind of considerations? So in this slide, just want to say, this last one can be mitigated. It's not something that is always very easy to decide, but I created a lot of resources to help you make your informed decision in terms of what you can invest into in context of your moral values, really comparing different options for you. And we're going to go through that in a minute or let you know where you can find that. So imagine where you could be in 12 months from now, because I'm assuming most of us want to have assets that we can invest into in the long run, see our wealth grow over time without having to spend countless hours trying to figure out what the next runner will be. And we can basically do this with ETFs. So you could be confidently investing and watching your wealth grow automatically, knowing that it matches your moral values, what you invest into, and doing so in a controlled way, taking control of your financial future. And I feel like this is definitely what it has done for me and many of my friends and other people that have done this course. Though statistically speaking, the sad reality is that most people that will watch this will not take action. And therefore nothing will really change. And while learning is a great thing, not taking action will lead to no change. And no change will lead to basically status quo, and nothing will improve to be the better. So I really want to stress here that taking action now is key. Do some more research, inform yourself more, and then perhaps start with a very small amount and just get in the game, get some skin in the game, see how it is it for you, Is it, are you not comfortable with it? It's everyone's decision to make, but I think if you want something to change, taking action is really key. So far you've learned the 3-step ETF investing blueprint, sustainable investing, the basics, and you've seen some real comparisons and performance. And only action takers will really succeed. I mean, we saw it at the very start. Like the people that invested 5 years ago, they were already realizing the gains, and those gains are exponential, as we can see here. These numbers, they just add up as we add interest upon interest, getting more and more gains. So, the sooner we start, the more our growth will be. And we don't have to invest a massive amount, like, 100 euros a month already, or, you can have $50 a month or whatever you are comfortable with. Don't overdo it. Don't go crazy and start investing all your money into one thing, but spread it out. Start with a small amount and see what you're comfortable with. And really educate yourself financially further every single day to progress your financial future in a way that you think is best for you. There's different sources as well. Don't just trust my word. Do some more research around this, definitely. And then take action. It's very key. Otherwise, nothing will change. Hope you enjoyed this free masterclass, and keen to hear from you very, very soon.